Jake saw the headline last Tuesday. 30-year Treasury yield spikes to highest level since 2007. He almost scrolled past it, because Treasury yields sound like something that exists in a different universe from his actual life. His mortgage, his credit card, his job, his retirement account, his grocery bill. And then, something made him stop. 2007. The last time this happened was 2007. And what came after 2007 changed every American's financial life for a decade. So Jake clicked, and what he found made him sit down and start making calls. Today, I'm going to decode exactly what a $2.5 trillion credit wave actually is, why the 30-year Treasury spiking to its highest level since the financial crisis matters to ordinary Americans, and most importantly, what it means for your mortgage, your job, your retirement, and whether the pattern we are seeing right now is telling us something that most people are not ready to hear. Let us start with the basics, because most people hear Treasury yield and immediately tune out. So let me translate it into language that affects your actual life. The United States government borrows money by selling bonds. Treasury bonds. When you buy a Treasury bond, you are essentially lending money to the government, and the government pays you interest. The yield is the interest rate the government is paying on that loan. The 30-year Treasury yield is the interest rate on money lent to the government for 30 years. Right now, that rate has just spiked to levels not seen since 2007. And here's why that matters to you directly. Mortgage rates are not set by banks. They are not set by the Federal Reserve. They are set by the bond market, specifically by the 30-year Treasury yield. When the 30-year Treasury yield goes up, mortgage rates go up. When the 30-year Treasury yield goes down, mortgage rates go down. They move together, almost perfectly, which means the spike you just saw in the 30-year Treasury is about to show up in your mortgage rate, if it is not already. Let us talk about what this actually means in dollar terms, because this is where it gets personal. In 2021, when the 30-year Treasury was at historic lows, a 30-year fixed mortgage rate was sitting around 2.7%. The monthly payment on a $400,000 home with 20% down was approximately $1,300. Today, with the 30-year Treasury at its highest level since 2007, mortgage rates are sitting above 7% in many markets. The same $400,000 home, same 20% down, same 30-year term, costs $2,100 per month. That is $800 more every single month, $9,600 more every year, and $96,000 more over the first 10 years from the same house, because of what happened to one bond yield that most Americans have never heard of. Now, let us talk about the $2.5 trillion number, because this is the wave that is building. Right now, $2.5 trillion in corporate debt is coming due for refinancing in the next 18 months. $2.5 trillion, companies that borrowed money at 2 and 3% interest rates during the pandemic era are about to refinance that debt at whatever the market charges today, which is significantly higher. What does that mean in practice? A company that borrowed $1 billion at 2% was paying $20 million in annual interest. When that debt comes due and they refinance at 7%, they are suddenly paying $70 million in annual interest on the same $1 billion, the same debt, $50 million more per year, going to interest payments instead of going to salaries or expansion or hiring or research or anything else. Multiply that math across $2.5 trillion of corporate debt, and you begin to understand why this is called a credit wave, and why the people who understand bond markets are watching this very carefully right now. Here's where it connects directly to your job and your career. When companies face dramatically higher debt costs, they respond in a limited number of ways. They cut costs, they reduce hiring, they delay expansion, they eliminate positions they were going to create, and in some cases, they eliminate positions that currently exist. The companies most exposed to this refinancing wave are not just small businesses. They are the mid-sized companies that employ millions of ordinary Americans. The kind of company that Jake works for. The kind that does not make headlines when it quietly eliminates 200 positions in a restructuring. The kind that blames the decision on market conditions, which in this case would be exactly right. Now, let us connect this to what happened in 2007, because the comparison in that headline is not accidental, and it is not just about the number. In 2007, the 30-year Treasury yield also spiked. It spiked because the bond market was absorbing the early signals of stress in the mortgage system. Yields went up as investors demanded higher returns to compensate for what they were sensing was increasing risk. What came next was the 2008 financial crisis, the worst economic event since the Great Depression. Now, let me be very careful here. Because I am not predicting that 2008 is about to repeat, the situation today is different in important ways. Banks are better capitalized, regulations are stricter, the Federal Reserve has more tools than it had in 2007, but the pattern of a 30-year Treasury spike coinciding with a massive wave of debt refinancing at dramatically higher rates is a pattern that deserves serious attention, and most Americans are not paying any attention to it at all. Here's what Jake decided to do with this information, and what you might consider doing as well. First, if you are thinking about buying a home, understand that mortgage rates are unlikely to come down significantly in the near term. The 30-year Treasury is telling you that, the market is telling you that. Plan around the rates that exist today, not the rates you are hoping will come back. Second, if you have variable rate debt, credit cards, adjustable rate mortgages, home equity lines of credit, this is the moment to take that seriously. Variable rate debt gets more expensive when Treasury yields rise, and they have just risen to levels not seen since 2007. Third, review your emergency fund. If corporate debt costs are about to spike across the economy, the job market is going to feel pressure. Having 3 to 6 months of expenses in cash is not just good advice right now. It is essential preparation for an economic environment that is about to get harder for a lot of companies. Fourth, do not panic sell your investments. The instinct when you read something like this is to sell everything and wait for things to get better. Historically, that instinct is wrong. The people who sold in 2008 locked in their losses. The people who stayed invested recovered, and eventually made significant gains. The right response to economic uncertainty is not panic. It is preparation, and preparation looks like cash reserves, low variable rate debt, and a clear understanding of your own financial situation. Here's the bottom line. A $2.5 trillion wave of corporate debt refinancing is building right now, at interest rates dramatically higher than when that debt was originally borrowed. The 30-year Treasury just confirmed that rates are not coming down anytime soon, and most Americans are scrolling past the headlines, thinking, cool, who cares? Treasury bonds, Jake cares, because Jake understands that what happens in the bond market on a Tuesday morning shows up in his mortgage rate, his company's hiring plans, his job security, and his retirement account. By the time most people notice, the wave has already arrived. You now know it is coming. You have been decoded. If this video connected something you felt in your daily financial life to something you did not understand was causing it, subscribe to Money Decoder 3004 every single week. We decode the economic forces that affect every American's financial life before most people know they need to pay attention. Simply, honestly, and clearly, drop a comment below. Are you worried about what rising Treasury yields mean for your mortgage, your job, or your investments? Tell me what you're seeing. I read every single comment, and I will see you in the next decode.